Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Joining us now, Claudia Sahm, of course, with her work at the Fed for many years and definitive on the American economy. Here we are, 22,000 is the headline number, distant from the old number of 150 being healthy. How close did we come to a negative number? A change in manufacturing payrolls, revision negative. Actual statistic, negative 12,000. But far more, it's about moving forward with the Fed. Claudia Sahm is with us with New Century Advisors. Claudia, this sets us up even more, as Anna Wong and Stephen Englander and Claudia Sahm have said, for this important September 9 revision. When you see this tepidness, including non-farm 3-month moving average of 29,000, how do you interpret what we may see with a big negative revision September 9th?
Right. So first, I'd say just from the data today, this ought to be able to convince people at the Fed who were on the fence about doing a rate cut. This really does speak in terms of it's time to start adjusting interest rates downward. I think it still fits within this is a risk. There are a lot of reasons that job growth could be slowing because of labor supply, and it is very consistent to see that. And the unemployment rate tick up. It's not jumping up, it's moving up. But this really does firm up the case that Powell made in Jackson Hole and Chris Waller has been making about it's time to start cutting. But I still think this data is in line with a gradual pace of cutting. The data that we will get next week on the annual revision, that is a preliminary estimate for the level of employment in March of this year. So it really is not going to tell us anything about what's been happening in recent months when we've had this, slowing in job growth, because the policies have changed so much since March of this year. So it's important information. We'll be watching it. But in terms of kind of, adjudicating what's happening right now in the labor market, right, it's not going to be that helpful.
Paul, the 2-year yield almost back to those April low yields.
Yeah, I'm keeping an eye on that, Tom. Claudia, to the extent that this data today maybe does prompt this Fed to move in later this month, how do you think the cadence of their subsequent moves will be for this Fed?
The cadence is going to come off of the data. I think we have to remember we are still in an environment where inflation is elevated, and we are likely to see CPI prints that firm up in the coming months. So I still think in a best case where the economy is just moving along, we're in a slower growth place. So this is not, a super place to be, but we're probably going to have some push and pull of the employment data and the inflation data. And so I don't necessarily think we're set up right now for a full cutting cycle, but the data will drive on this one.
We welcome you across America, around the world. It is Bloomberg Surveillance on YouTube. Subscribe to Bloomberg Podcast for your office, for your home as well, growing each and every day. Somebody emailed me, Tom, we listen to YouTube in the car.
Do they?
They do it through their cell phone.
Okay.
I don't know. I mean, I only got an iPhone 5, so it doesn't work, but they do it on radio across the nation. Traditional 99.1 FM, Nathan Hager Radio. Good morning in Washington, Labor Secretary coming up. And of course, 92.9 FM in Boston on this Jobs Day. Equities sustain pretty much where they were 2 hours ago. The VIX 15.05. Paul and I watching that 2-year yield really getting back to the September 24 and April 25 lows. We'll see where we go from there. Paul?
So, Claudia, the Fed, obviously data dependent, as we know, but now they also have to deal with maybe some outside external political pressure. How do you think that's affecting this Federal Reserve these days?
In terms of the decision that they'll make in September, it should not be affecting them. They're going to look at the data. They still have a majority of people on the FOMC that are, adhered to, and they all unanimously agreed to their updated framework last month. And that's all about data and all about looking at these risks. And so in terms of the decision, I don't think that changes anything one iota. In terms of the concerns, in and outside of the Fed, they are just, off the charts right now. Like this really, the Fed could be a very different Fed in not even a year from now.
Okay, Claudia, I got to ask you this question, because you're probably the only one I know who read cover to cover A History of the Federal Reserve, Alan Meltzer, 1913 to 1951. Did you read that entire book?
It's a very good book.
It's a very, she's the only one I know who read like 1,500 pages. Here's my mail, okay? My mail is this. Tom, you idiots, you fancy urban idiots in bow ties, we're in recession. How do you interpret, Claudia, the percent of America that is living recession right now?
So, this is a tough one, and it's really a question not just for the Fed. There are demographic groups that have unemployment rates in the best of times that look like recessions for other demographic groups. We have some real structural problems and differences in our economy. The Fed's tool with interest rates is a really weak tool. So the best thing they can do, and it helps everybody, and particularly those on the margins, is to keep the economy as stable as possible, keep inflation low, keep unemployment low. And that is their mandate, but that's a bigger mandate that goes beyond the Fed.
Claudia, you're foundational to us. Thank you so much for being the bedrock of our job day. Surveillance correction?
Yep.
Claudia, when she read Alan Meltzer, it was only 810 pages.
Gotcha.
Dr. Sahm, thank you so much, of Michigan and the Fed and New Century Advisors. Biggest fight I ever had with Alan Meltzer, he said, Tom, you have to aggregate the economy.
Okay.
You can't. Can we segue to equities?
Oh, that's derivatives?
I think we should. We've been doing fixed income all morning. The bond market, we're looking at the 2-year come in on the certitude of a rate cut. 30-year bond, 4.81%. We're bond free. Joining us now, Amy Wu Silverman, head of derivatives strategy at RBC. Okay, we're partitioned into the haves, the AI boom, and a lot of people really ugly in this jobs report in slowdown, recession, stagnation. How polarized is the equity market when you look at the derivative cross moments right now? Is it like 30 stocks and everything else?
A little bit, yeah, Tom. So, it's always comes back down to that concentration risk. You see that spread between equal weighted versus index weighted, and that spread keeps getting wider. And I think we keep getting that hope that that'll narrow. We kind of came in with the September scaries, but, post this report, I'm curious what the market does, because we kind of were well positioned for this. And I'm curious if we go back to everything as it was.
What's the positioning when you look at skew, and particularly this thing gamma, where people are looking at the speed of movement?
So I think this is really important. Post Liberation Day, Tom, September and October specifically, skew super steep, so really high demand for hedging, and term structure really steep. Now we're here. And so my big question is, do we capitulate first, or do investors? Because to some degree, we were kind of looking through these now with these data points. And I just think back to 1 year ago, how similar we felt, right? If you think about this data point 1 year ago, and what did the market do since then?
So your parents call you up and say, nah, we got it right, you didn't.
So in your market, the derivatives market, are they buying protection? Are they skewing towards more risk position? What are they doing these days? What's the sentiment?
So they were very well set up specifically into this tenor. They were well hedged. And the one thing we learned from April 2nd is that you can be well hedged and well monetized, but you can not be right on the velocity up. So that's my question now. I think we kind of protected our left tails. We kind of knew this was coming to some degree. It was well telegraphed. That non-farm payroll straddle break even was like 0.57%. It was like a nothing burger coming into options. That, to me, that's interesting.
Nothing burgers, Nassim Taleb.
That's the official term. And, so that tail has been protected. And now the question is, if we get some sort of knife up, where do we sit on the right tail? I think that side has not been well protected yet by the same set of folks.
Does your market care about the Fed, the independence of the Fed, maybe some pressure that the Fed may be getting from the executive branch? Does the long-term option market, do they care about that?
They do. And, it's interesting. If you think about the first tantrum the market had, it was mostly around the comments Trump made about firing Powell. So the market didn't like that, right? Then we kind of fast forward to Cook. there's less of a reaction. But to me, it was like all part of the same reaction. The thing that I wonder about is, people kind of have stopped talking about this Trump taco trade. I wonder if we really get severe steepening in the rates market, if we get higher volatility, if he doesn't just step back his comments, because that's what he has done in the past. And he does recognize certain safeguards where he's like, I've gone too far and I got to step it back.
On jobs day, we digress to the equity markets. We do that with futures pretty much stable off where they were 2 hours ago, pre-jobs report. We were up 0.7, we were up 0.5 on NASDAQ 100. That's where we are right now. Futures up 9, S&P futures up 9. Amy Wu Silverman dazzles us from RBC Capital Markets. Okay, trend following the CTAs. I'm looking at a very, very famous growth, successful Morningstar 5-star fund, and it's getting right up, buttressed up near 2 standard deviations on a weekly chart. How extended are CTAs? Is trend following now legitimate, or is it so stochastic that you can't make a bet?
I definitely think on the margin it's important to watch, and as you said, it's kind of getting filled up. And at the same time, there's a lot of kind of seasonal weakness that you get the September scaries. And then on top of that, you see retail weakening. And I think that, to me, is why people have been very nervous about this month and next month. My question about it is, Tom, is like, this has been the most well-telegraphed potential drawdown in history. And so, like, how much velocity do you get into that before it snaps back? Like, 'cause to me, April 2nd felt exactly the same way. And we kind of saw what happened there.
Does your market have a view on valuation, concern about valuation, not worried about it? Like, well, if I have a concern, I can hedge it away. How does valuation come into your market, the derivatives market?
I remember being in a client meeting recently, and it's like no client meeting is filled until you talk about AI and concentration valuation. And the client just said, like, has the market ever really traded off because of valuation? So meaning not that it's good or bad, but has that actually in and of itself been a catalyst, the same way that like really strong concentration, a couple names have been a catalyst? And that's the thing about the market, is that's not like a specific event risk. It's just something that exists. And unless something else perpetuates that in and of itself doesn't cause drawdowns historically.
You and I kneeled at the altar of Peter Lynch, and what he's going to say is, look, every 90 days they show up and they deliver revenue report, down the income statement, earnings report. Let's modernize it over to free cash flow. With all the abilities of RBC, do you see a breaking of the model September 30th into the October earnings season? I don't see it.
I don't think so. And I think this is what I mean by, like, it has felt very telegraphed, literally since April, May of this year, that we were going to get some sort of drawdown, some sort of September scaries,
earnings
and it was
failure.
Whatever it is. And so my question is, if we've all been so well positioned for this and that gets monetized quickly, then what happens after that? Are we literally, on your iPhone where you get like this day 1 year ago, like, are we just in for a repeat of September 6th, 2024, and what happened the month since then?
What are you hearing from your clients? She walks in a room. I mean, you can hear a pin drop. They're like, quantitative finance, Princeton. Shut up. Don't ask a question. What do you hear from your clients?
The big question I get asked from them is, all the positioning data right now would suggest that there's kind of weakness in demand the next few months. But the question is, especially on the retail side, has there been some sort of tectonic shift where that just doesn't apply anymore? And it's really interesting because every time, we just had our summer interns, they're all gone now. But every time I talk to interns, my favorite thing to do is poll them and be like, are you buying the market? Are you buying the market? Because there is this cohort that we see much more frequently in the options market that has not stepped away. And I'm very curious if we get some sort of substantial move, if that occurs again.
30 seconds. Have you talked to Taylor since the engagement?
No, I worry she's not going to tour because she's engaged now and she's too busy. Like, is she going to tour for Showgirl?
No, she's not,
I'm very disappointed in that.
We got her caviar bowl from Scully and Scully.
Wow.
Went over on Park Avenue. I mean, they have everything.
It's a beautiful gift.
What do you get them? I mean, they have, how many houses between the two of them?
I don't know.
A puppy.
Jersey Shore guy.
Couple, we'll have to see. Amy Wu Silverman, thank you. So don't get her another caviar bowl. We've got that taken. Amy Wu Silverman, RBC Capital Markets, here where the markets pretty much stasis off the shock of a 22,000 statistic on non-farm payrolls, 4.3% unemployment rate. We need an update from the Interactive Broker Studios at Bloomberg Business Flash on Jobs Day. Lisa Mateo.
You got it in this Business Flash, brought to you by Oracle. Attention growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, see if your company qualifies at oracle.com/Bloomberg. So yes, we have a mixed look on Wall Street. This is after U.S. got job growth. It cooled considerably last month. Unemployment rose to the highest since 2021. So a breakdown. The data showed non-farm payrolls increased 22,000 in August. Revision showed employment shrank in June, the first payrolls decline since 2020. The jobless rate ticked up to 4.3%. So now we have NASDAQ futures up 0.6%, 155 points. S&P futures rising 0.2%. Dow futures little change, down about 32 points. The 2-year yield 3.49%. That's down 9 basis points. The yield on the 10-year 4.09%, and that's down about 6 basis points. The dollar headed for its weakest showing this week. Right now, the Bloomberg Dollar Spot Index down 0.5%. We've got oil slipping. WTI crude down 1% at $62 a barrel. Gold on the rise. COMEX gold at $3,634 an ounce.
Thank you.
There you go. Yeah. Got to do that for you. That is your Bloomberg Business Flash. Paul and Tom.
Are we modeling 3,700 gold?
I think you have to. I mean, there's just nothing stopping this thing.
What does that do for prices at Tiffany's?
I know. It can't be good. You got to pay up.
There's talk about elasticity.
Yeah, exactly.
Lisa, thank you so much. Lisa Mateo there, the report. I'm watching NASDAQ 100 futures up 0.7%. All in all, advancing here off the jobs report. The VIX 15.07. Bloomberg surveillance on this jobs day with day after day support from Commonwealth. Commonwealth joined over 2,000 independent financial advisors. They're taking control of their growth with advisor-centric support and future-ready technologies. Grow in your own terms with a partner dedicated to your success. Go to commonwealth.com to learn how. We're killing it. Ken Rogoff, Rebecca Patterson, Claudia Sahm, now Kristina Campmany with us from Invesco. Same question I'm asking everybody else. If we get rate cuts, CIBC Economics Toronto saying Bank of Canada, moldy numbers, they suggest Bank of Canada has got to cut. If we get rate cuts, do we get the same efficacious effect in the system and in the bond market? Is it a normal rate cut?
I don't know if it's a normal rate cut or what we've historically been used to, because I think we're pulling a lot of levers. We're kind of back to that same feel of the beginning of the year, that we're getting so many policy moves from the administration at once. How do we weigh through them? What is the impact? Which hits first? And I think we're in the same thing. The market's digesting. We've fired the BLS chair. We're pulling all of these strings with the Fed. The market's contemplating Fed independence. And I don't think we're seeing all of it in the real time immediately today. But it all adds up, and I think it will bleed through. So, and then I think when you talk about global central banks, a lot of global central banks have eased ahead of the Fed and more already, right? Like the Bank of Canada has eased significantly more than the Fed to this point.
Brian Jacobson, Annex Wealth Management, out with a note here. A 50 basis point cut is back on the table. So that's one interpretation of kind of some of the data points we saw here today. So, Kristina, you sit here with the 2-year Treasury yield at 3.5%. It's not the 4% we had before, but still pretty solid. How do you think about treasuries versus credit risk here?
Yeah. So I think the Treasury market, we still think that the thematic remains the same, that the curve should be steeper. And the front end has done a lot of work. As you said, we're all the way to 350, but does it probably continue to perform here? Because the questions are we getting just this slowdown, or is there a real risk of breaking in the labor market, right? Like you've had a lot of mixed data until last month's payroll report. It really had just been the soft data that had been weakening and everything else was resilient. The consumer still seems resilient. So I think the front end still provides value in a portfolio for sure. We still like steepeners, so being short long end bonds, I think that's a global phenomenon. And then first credit markets are tight, and they have been tight. I mean, that hasn't stopped money from flowing in. You look at the massive pipeline of supply that's come to start September, absorbed with ease.
Thank you. I mean, to me, that is the absolute headline, is the wall of money. Good morning, Lawrence McDonald, who wrote an essay, courageous essay on that 3 years ago. Here's my reality, and I think it's unknown. You live this every day. The Bloomberg Total Return Aggregate Index on price basis has advanced 16% from the gloom of a number of years ago. We're easily 3/4 of the way back to the peak before the huge collapse that was out there. Ken Rogoff's given us a debt and deficit austerity view. The street and Invesco saying you can buy, you can participate in the market. How do you manage the fears out there of the debt and deficit long term?
Look, so I think it goes back to weighing those two things. Within credit, we look at credit across the board and we think it looks tight. And so if we're going to hold credit paper, we'd rather do it in the front end. And I think kind of globally where you have to be most concerned because of all of these things that we're talking, inflation risk, credibility risk, deficits, all of these means like I'm not being compensated significantly enough, even with bonds kind of sitting around 5% to own that paper with all of the risks that are out there. And then I think the clearest trade is still in currencies, right? Like this all speaks to a weaker dollar. That's
where I want to go, the dollar here. I mean, I've seen my stock market bounce back. I mean, a lot of other risk assets have bounced back, but the dollar's still 8-9% below its early year peak. Is that just because the dollar was maybe overbought in the new year with President Trump, animal spirits, all that kind of stuff? Or is it telling us something else?
I think it's a combo. And I think you have to take a step back and say, we're coming from a 10-year dollar bull run. And are some of these big thematic things changing? For us, it's been all of these building blocks all mean a structurally weaker dollar. We're talking about tariffs, which are a tax on the consumer. We're talking about even, again, we've talked a lot about this of, are people de-dollarizing? I mean, people are not selling dollar assets because there isn't an alternative to a lot of the depth of the U.S. market, certainly in equities. But does the marginal next dollar get invested in home currency for pensions and accounts like that? I think that all still means we had the quick move in the first half of the year of the dollar, but that theme remains with us.
We're going to talk to Global Wall Street right now. For those of you, hold on, two hands on the steering wheel if you're driving right now. Kristina Campmany of Invesco with a clinic. Okay, the vanilla spread is the difference in yield between the 2-year and the 10-year. That's what the media quotes. Most people don't know what the dynamics are. The 4-box outcome you can have with two numbers moving up and down. Maybe you look at the 2-year, the 10-year, the 2-year, the 30-year. The adults like Kristina look at the difference in yield between the 10-year and the 30-year. Kristina, it's a moonshot in 2025. That 30-year bond extending way out. This is my Peter Fisher imitation.
Yep.
My 30-year yield is extending way out higher than my 10-year. Is that a kind of thing where it snaps at some point? Or do we just get back to where we were 3-4 years ago?
Snaps which way? Snaps back or snaps further breaks
What's
down?
What's the dynamic of that moonshot steepness?
I mean, we've steepened a lot this year. We've certainly steepened more in cash and treasury space than in the swap market. I think swaps curves are still kind of not kind of giving that. But if you take a step back of historically, you talk about curves that are 200, 300 basis points steep when you talk about 2s, 10s, and we're still not there. We're
not back to normal.
No, I mean, and again, you're coming off post GFC, zero lower bound, this different dynamic. So are there perhaps things that are different that you don't get to a 300, 400 basis point steepness, but can you be steeper? Sure.
How does a bond person lift the stock market? She single-handedly lifts the market right now. NASDAQ 100 up 0.8% because of Kristina Campmany. Thank you so much, Kristina. Really treasure having you here on Jobs Day. To go from Rebecca Patterson to Claudia Sahm, Kristina Campmany there. It's adults on Global Wall Street. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
My book of the summer, hugely successful for Ken Rogoff, was Our Dollar, Your Problem. I put it out last night as a summary, along with Rick Atkinson's wonderful second volume on the American Revolution. The Rogoff Revolution, as he has done with Carmen Reinhart a decade ago, and through his career, is to consider our debt, our deficit, our battle with austerity. Professor Rogoff joins from Harvard this morning. Ken, thank you so much. Congratulations on the book. Give us an anecdote, Ken, of the success of the book. I want every economics student to read it. Are they?
Oh, as people are starting to read it, they're really enjoying it. I'm getting all kinds of emails, letters, not to mention countless reviews where people have sort of been surprised that it's so fun to read.
It's great. Lisa noted that Grace Slick is in the early pages. He's got Jefferson Airplane in there early. Okay, Ken, Project Syndicate, a blistering essay, Foreign Affairs Magazine, a blistering essay. This time is different. Are we finally unraveling our debt and our deficit to crisis?
Well, in my book, I thought it would take 5 to 7 years on the current track we are. I think Trump, as you said earlier, is an accelerant. It's certainly not a sure thing. A lot of it goes around what are the underlying interest rates. If we go back to the zero interest rates, real interest rates of the 2010s up through 2022 in the pandemic, well, sure. Debt is a free lunch. I mean, you can spend and you basically don't have to pay anything. That's what all the I call them anti-austerians were absolutely convinced, and some very smart people, you had them on your program, followed this. I mean, there was Larry Summers' Secular Stagnation. He's very nuanced about it, to be fair. Olivier Blanchard, president of the American Economic Association, said we shouldn't look at debt anymore. Paul Krugman, wrote constantly about this. But what do you know? Interest rates have gone up. And the big question is, have we normalized, or is this just something after the pandemic? I think for many reasons, if you look at the history of real interest rates, they're probably about where they're going to be for a long time, in which case we are in trouble. So that's a long-winded answer, but it's really about interest rates, not just about debt.
I want to get this in on interest rates. Paul's got 8 questions. He wants to jump in here, but the answer, Ken Rogoff, is I'm auditing Ec10 with Jason Furman, so I did a fancy logarithmic 30-year bond. We get to the Ken Rogoff 6% 30-year bond, Paul, late next year, like autumn of next year. Yep. Ken, do you still model a 6% yield for the United States of America?
Well, I think a 6% 10-year Treasury is more likely than 1 3/4 Treasury that we had for a long time. Absolutely. I mean, it's very hard to predict interest rates, but I think they're as likely to go up as down.
Professor, I've been in this market for 35 years, and we've been talking about the national debt and deficits every single year, yet nothing changes. And I guess I've been told by others that say, hey, as long as people continue to buy our Treasury bonds, we're okay. How do you think about that?
The question is, at what price? We've gone through this period where interest rates have gone down and down and down, and our debt, has gone up from maybe 30% of GDP in 1980 to 60% to 90% to over 120%. And the interest rates had been coming down until they didn't. Yep. And if you look at history, there have been long periods where interest rates were rising, where they're in decline. And I think they're in a period where they're normalizing. So people were too focused on debt and not looking enough at, well, what's the interest on the debt? That's what's changed.
What would you, if you were sitting in Congress and you had a couple of folks on both sides of the aisle with you, what would you suggest they do to address this issue?
Well, why don't you at least give a try to running a 2 to 3% deficit instead of a 6 or 7% deficit, while you organize. I mean, the solutions are well known. You could improve the tax system. There are ways to make it more efficient. We don't have a very efficient system, would be the understatement of the year. There are all kinds of suggestions for improving growth. But I think sort of a sober thing to do would be to at least not run what we call a primary deficit, means above and beyond the interest payments, which right now are about 3% of GDP.
I just want to drop in here with an important announcement separate from Ken Rogoff, and we're thrilled you're listening to us across the nation today and indeed around the world. And in a fractious United Kingdom, Angela Rayner resigns as U.S. Deputy Prime Minister. I'm not going to go into the nuances because I don't understand it, but there has been an uproar in the Labour Party wrapped around the Deputy Prime Minister. She resigns and also will resign various posts at the Labour Party as well. So that's breaking news in the United Kingdom. We'll have perspective for you as we can. We continue with Kenneth Rogoff. Paul, why don't you pick it up with Professor Rogoff?
So, Ken, as we think about just kind of global economic growth here, and we're now in a world of tariffs, reciprocal tariffs, all kinds of barriers going up to global trade. As you step back and look at it from a 30,000 foot level, what does that mean to you for kind of global economic growth?
Well, I think near term, the growth is held up better than anyone would have guessed with all this noise going on. That's been a surprise. Now, we may find you're getting the labor data today and, it wasn't as good as we thought it was. It's hard to know what's going on. I might interject, Labor Day, Jobs Day has always been the big number because it's the most reliable number that we get sort of in real time. Maybe now and going forward, it's not going to be considered as reliable, and I don't know what we're going to look at.
Ken, I look at your book, and I want to bring this back, folks, to a summary of all the crises across Ken Rogoff's young academics. It's amazing how he shows up for a job interview in a polyester suit. How did that go, Ken Rogoff? You showed up early in the book, young Rogoff, chess guy, shows up in a polyester suit. How did that go, Ken?
Yeah, it was my Rhodes Scholarship interview, and I had just never worn a suit. I'd never bought a suit. I didn't know what it looked like. So I had this it was really beautiful colors. I looked like I was probably some kind of entertainer, and everyone else was wearing gray and blue suits. And I tie it in later to when I go to Poland playing in a chess tournament, and I'm describing how their suits are awful because they have, centralized planning, and they're looking at my suit and say, "Oh my gosh, do all Americans have such great suits?"
Ken, I look at your problem, and it speaks of crisis. Just as a general statement, and I'll let you work off it. How close are we to the collective fears of global Wall Street of August 1998, the unraveling of various EM crises, Ecuador, Mexico, and the rest, or something tangible like the IMF bailout of the UK many decades ago?
Well, there are lots of small countries in crisis, in fact, way more than in a long time. I mean, the World Bank reported that almost half the developing and low-income countries were basically in default. We have the Sri Lankas, there's always Argentina, Lebanon. I mean, there's all kinds of countries that are in trouble. I should say Argentina is doing much better now, but of course it has a very big debt problem. Those often are the canary in the coal mine for when something larger happens. If you go back to the 1983 debt crisis, that was really, the Latin American debt crisis, the lost decade. Actually, if you go earlier, before Mexico, Brazil, and everyone else, there were a lot of small countries. So when you have interest rates high, this much volatility going on, very high debt everywhere, it's, like a forest that's very dry and something can set it off. But, I don't know what it would be. It would not surprise me if we did have a major country run into big problems, which could run anywhere from, a Latin American country to Japan over the coming year.
Ken, given kind of that uncertainty, global uncertainty, this Federal Reserve is really in a tight spot here, and not to mention the political pressures on this Federal Reserve. What do you make of kind of how the Fed's kind of been working here over the last several months, and maybe what it'll do over the coming months?
Well, the big call is actually not whether to take the short-term interest rate down 0.5% or 0.25% or when to do it. The big call is, where are we headed? If we're headed back to these very low interest rates, which some very smart people think, I mean, this is a debate, then they have a lot of room to cut without triggering inflation. They'd sort of be moving the market to where it should be. On the other hand, if that's not the case, which I believe, and I think by and large the Fed staff is very skeptical of the lower forever view, then they need to be cautious. It's so hard to read the data. The combination of Trump, AI, and everything makes it very hard to know what's going on.
Can comment on the arch thing, and this is, of course, working with Jorgensen at Harvard and many other giants on, I'm going to call it, folks, the dynamics of productivity. And there's a school, Ken, down the street where I think they came up with total factor productivity. I can't remember quite. But Ken, on productivity, the great theme of our liberal state is productivity and technology to the rescue. Do you observe that, or is that overemphasized?
Well, it's certainly not overemphasized. It's very important. It's sort of hard to know how to make it come and how to make it go away. I think Wall Street obviously has been very excited about AI. There are air pockets where the productivity has been very clear. I do think some of what we're seeing in the high Wall Street prices reflects labor share falling, profits and businesses share rising, which means it isn't growth. It isn't all growth. Some of it's just a reallocation that has very different political implications, of course.
Ken, congratulations on my book of the summer. I just can't say enough, folks. Whatever smart aleck kid you got, I don't care how they're smart like Rogoff, they're dumb like Keene. The answer is cover to cover, 200 pages, Our Dollar, Your Problem. It is the arc of Ken Rogoff's career and the view forward as well. Kenneth Rogoff, Harvard University. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto.
Joining us now on this job day before Claudia Sahm, Rebecca Patterson joins us with all of her work at Bessemer Trust at Bridgewater and at the Council on Foreign Relations. Here's what I want to know. I've been dying to talk to you. How efficacious will Fed rate cuts be, or is our economy, tariffs and all, in such a jumble that a series of quarter-point cuts won't provide the salvation we're used to?
Good morning, and that is exactly my fear. So when we hear members of the administration saying rate cuts are needed, the housing market will swing, those were Trump's words, we're in a different regime. Inflation running, core PCE running at close to 3%, instead of 1% or 1.5%. Remember, we had extremely low inflation the last 20-ish years. And so the Fed didn't have to worry about that. It could focus on the job side of its mandate. So when it cut, you didn't worry about inflation getting out of control, pushing up the long end of the yield curve. You just gave liquidity to the market and you helped create jobs. Today is different. If we cut, yes, we're going to provide liquidity. Yes, that helps the discount rate for equities, but it doesn't necessarily translate into a swinging housing market. I think the risk goes the other way.
So as we step back here, I mean, what do you think the Fed is really focusing on? The labor market, inflation, trying to balance it?
Yes.
What do you think is front and center?
Yeah, I mean, they are trying to balance it. They're very worried about inflation and inflation expectations rising. It was bad enough, the hit they took after missing it a couple of years ago. They don't want to do that twice. At the same time, there is more and more data coming out suggesting the labor market's cooling. And what they want to avoid is that hockey stick moment that we've seen historically when, slow, moderate job reductions become much bigger ones. And that could happen. I don't say it will. Right. But so they're trying to balance that. I think a rate cut this month, no harm, no foul. Right. Yep. 140 basis points by the end of next year is different.
Unemployment rate, I mean, the consensus here, Rebecca, is 4.3%. Right. It's a little bit higher than last month, but I don't know. It still feels like full employment to me. What do you think the number is the Fed's looking at?
Yeah, the big story with unemployment rate is that and Powell talked about this at Jackson Hole last month, is that you have fewer net new jobs being added, but you also have less supply of labor. And so those two things together are helping to keep the unemployment rate relatively flat. So because you normally don't see this huge decrease in labor supply, that's coming from the immigration deportations and lack of new immigrants, that's usually not a factor. So when the unemployment rate goes up, it goes up. We know what that means. Today, again, we're in a different regime.
So as we step back here, put it all together, when you talk to investors, how much risk do you think they want to take out there when they think about all these crosswinds out there and geopolitical issues? And what's the risk appetite? What's the sentiment out there?
I mean, with equity markets, earnings beat a low bar, but they beat, right? And stocks are near all-time highs. Now, I think a lot of that is retail investors. I think a lot of that still is investors who want exposure to the more structural trade themes like AI beneficiaries, global defense and infrastructure. But that is still creating wealth for consumers, which allows them to keep spending. So I think the risk appetite is there. But I think gold is sending us a signal, up 35% year to date. I worry that we're going to have a Brexit moment, that everything is fine, and then suddenly it's not. And that's what we saw in 2016. When the referendum was announced in February till the vote in June, UK markets were calm. And then June 23rd, we got the vote, and suddenly people said, oh, this is actually real. And everything collapsed.
Okay, so we got a technological revolution. I was busting Ken Rogoff's chops that the guys down at MIT got it right. High tech at Harvard is, can we get a defenseman to play hockey? So Rebecca, the bottom line is we've got an ambiguity here, which you studied, you're expert at. And that if rates go up, it's ambiguous. Maybe we do okay. But if there's this huge political effort of rates going down, what is the ambiguity? What do our listeners and viewers have to look one way or the other way?
So rates going down in part because of a politicized Fed, to me, means yield steepening continues. So the short end goes down of the curve, but the 10-year, the 30-year Treasury yields go up. That undermines the housing market. It undermines auto loans. It's going to be something that hurts the consumer. So I think the AI story, I wrote about this at CFR's website earlier this week. It's not just AI hurting jobs next year. It's AI investments companies must make that are increasing their costs. They need to offset that because they're keeping a close eye on budgets right now. And how do you offset that is personnel. So I think AI directly and indirectly is going to lead us to more job cuts next year at the same time that the curve is steepening.
Rebecca Patterson, thank you so much. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
She returns. Lisa Mateo with the newspapers. Good morning.
Good morning. All right. So we've been hearing about this big UFC cage match, right, taking place at the White House South Lawn. Well, the Wall Street Journal has a few more details about it. They say President Trump's daughter, Ivanka Trump, she actually practices Brazilian Jiu-Jitsu. She is a UFC fan. She's going to be part of the planning process. Lasers and fireworks are going to light up the sky. It was supposed to be 4th of July, but too many conflicts, obviously. Yep. So it's going to be sometime in June. Ahead of it, they're going to have a lot of days of UFC events, festivities on the National Mall, autograph sessions, things like that. Fighter weigh-ins, a press conference planned to be held at the steps of the Lincoln Memorial. Solid. Fighters could be warming up in the White House. So this is going to be huge.
It is.
It's going to be a big event. And UFC has been all, in the headlines. It's a big thing. We've heard a lot about UFC and the growing popularity of the sport. And the White House has held, tennis matches, t-ball fields, pickup basketball games, but nothing like to this size. So this is going to be.
Do you have any UFC people in your household?
I do. Yes. Right. And it's going to bring up a whole conversation for another day about where to watch it.
So how big is Conor McGregor? Is he like a ginormous deal?
He doesn't fight as much anymore. He's become like this movie star in a way too. Yeah. But it is huge, and a lot of people follow it. I love Georges St. Pierre. I'm more of a boxing person, but that's okay.
Next.
Okay, so NFL season kicked off last night. The Eagles beat the Cowboys, right? But for the first time ever, what's different is that NFL fans could watch every in-market game on their TVs without pay TV subscriptions. So that was a big thing. The question is now, how did you watch the game, right? Cable, streaming, what did you do? So Business Insider crunched the numbers to see what was a better option. And they say cutting the cord would only save you a tiny bit of cash, okay? So there's a new analysis. So if you subscribe to every streamer that carries pro football, you would only save, ready? $1.03 a month.
There you go.
Is it worth it? That's the question.
After all we've been through in the last decade.
Yeah, because you listen to it, okay? So NFL fans, okay, here's what you would need. Paramount Plus, Fox 1 to watch the in-market Sunday afternoon games on CBS and Fox. Then you need Peacock to watch NBC's Sunday Night Football. Then you need the ESPN app to carry Monday Night Football. Amazon Prime Video carries most Thursday games. So together, that's just about $78 if you want all that and have to manage all those subscriptions.
So, this is progress, I guess, is what you're telling me.
Yeah,
I mean, having grown up in the cable TV world, I don't get it.
It's just confusing. Like, you want to watch the game, where do you go?
Exactly. What I notice in the house is people are watching less TV. That's the immovable fact.
Yeah.
They're just watching less TV. That's what I see.
They just stream it.
Simple as that. You got one more
Get
for us?
Yes. Okay. So this is a review from Bloomberg's Top Shelf Society. A bottle, what they call, is one of the most fun vodka flavors to ever cross their desk. How do we get transferred to this department? What do we drink at work? It is pizza flavored vodka. It's from Rhode Island's Isco Spirits. Costs about $30. Okay. Wow. They say this one did us disappoint because it has this big tomatoey scent, oregano forward flavor, mouth-watering, garlicky exhale. It's also made with mozzarella, which is infused at the end. So they say, yeah, you know what? It does taste like a slice of pizza. So you can use it in, yes, a Bloody Mary, but maybe your next martini. Your next martini.
I mean, I love pizza. I love vodka, but I can't put them together.
You can't put them together? No?
I don't know. All right, Liz Mateo with the newspapers. Thank you so much.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.